Hello and welcome to an FX Times daily video recap. I'm your CMS Forex market analyst Nick Nassad. Today is Wednesday, January 6, 2010. The dollar was generally weaker today and hit intraday lows in New York afternoon trading following the release of the Federal Reserve meeting minutes. There, policymakers said that while the recovery was gathering steam, it was not strong enough for policymakers to decide to lift interest rates anytime sooner, and we also had some discussion about some more quantitative easing, which was dollar negative. Earlier in the day, we had the U.S. Post Services and Employment data, which showed firming in the U.S. economy. Thirdly, the main theme that we had today was a rise in commodity prices as oil continued rallying, which helped to boost commodity currencies. Before we get to our fundamental releases for today, here's a quick look at the euro-dollar pair, where we saw the Greenback gain overnight in the beginning of European trading, but following a test of below the 1.43 level, the euro rallied, hitting an intraday high above 1.44. If we zoom this pair out slightly, we see that we have a bit of a rising support trend line, as we've had three higher lows in the last 2 or 3 weeks. And while we could also say that we've had a bit of a rising in resistance trend lines, for the most part we're seeing this 1.4450 level acting as an important resistance of horizontal resistance, though we peaked above that shortly in yesterday's trading. Taking this pair out a little bit further, we see that right now we're in a bit of a consolidation pattern following our break of the 1.45 level, and with our support here setting up as I just showed you earlier. We also noticed that the last 3 sessions or 4 sessions have seen a pickup in volatility, which is expected following the end of the holiday season and the end of the year. So let's see what the FOMC meeting minutes had to say and why traders reacted by selling the greenback. As I mentioned, the FOMC meeting minutes showed that the Fed acknowledged that while the economy is gaining momentum, the speed of the recovery is not strong enough for the committee to change its view on keeping interest rates at their record lows. In other words, the Fed is signaling that it will continue to keep the flow of easy money going, which should help to support risk appetite, which is dollar negative. The statement said that the slower recovery can keep the labor market weak and should work to keep consumer prices subdued, while a few members even mentioned that perhaps more asset purchases were needed as a result of the significant slack in the economy. On the inflation front, the risks to the outlook remain roughly balanced, but there were both downside and upside risks. All in all, the release should temper expectations about the Fed raising interest rates anytime soon. Before we look at the US data, let's see a couple of releases from the Eurozone that came out today. Industrial new orders for the month of October slid 2.2%, which was a larger than expected fall. That also put the annual rate of orders down 14.5%, again, a figure that missed expectations. Secondly, producer prices in the Eurozone for the month of November were up only 0.1%, a pretty small increase and smaller than what was forecast, and that put the annual rate of producer inflation to negative 4.4%. In a breakdown of the data that you can see to the right, the main inflationary pressure came from energy, just like it did in October, as energy prices rose 0.8%. Turning back to the US now, we had the ADP employment change come out for the month of December, and it showed a loss of 84,000 private sector jobs for the month. As you can see from the chart on the right, the pace of job losses since earlier this year has been slowing, and today's figure for December was the fewest amount of job losses in the last 23 months. Goods producing sector lost 96,000 jobs, but for the first time since March of 2008, the services sector added jobs. And if you look at the blue line here, that shows the non-farm payroll release, which the ADP report seems to be lagging a little bit, and this could mean that we might see positive job growth. In a measure of the U.S. services sector, the ISM non-manufacturing PMI rose to 50.1 in December, which returned it to expansionary territory following a dip below the 50 level in November. However, the figure came in lower than expected. While business activity rose to 53.7 from 49.6 in November, new orders did dip slightly, though they remained in positive or in expansionary territory. And more importantly, we had employment index rise to 44.0 from 41.6, though unlike the ADP report, which showed services sector adding jobs, this report shows that the job growth should still be contractionary. In our chart to the right, we see that we've had a rising trend for most of 2009, but in the last 4 months, that trend has flattened out as we hit the 50 level. With those fundamentals out of the way, let's take a look at some more currency pairs. Here we take a look at the dollar-yen, which fell in favor of the yen in the last 2 sessions to start this week, but today had a reversal and rose to about the 92.75 level at its high. Zooming this pair out, we've seen a very strong rally in favor of the greenback in the last month of the year. And if we draw a trend line, we saw that our low on Tuesday ran up against it rather well. Yesterday's low also came close to a 2-week low that we had here around the 91.20 level. Today's session did see a bit of risk appetite as we had higher stocks, and we saw commodity prices rising, which should all be yen negative, as it has been the main funding currency now again for carry trade. Today we saw oil rise for a 10th straight day, reaching a 15-month high above the $83 a barrel level, which helped the commodity currencies, the Canadian dollar and the Australian dollar. Here in the US dollar Canadian dollar pair, we fell below the 1.035 level, which had been acting as our support in this week's trading. And we could see that we had a bit of a sideways consolidation zone that we now have moved below. The Canadian dollar has been a strong performer the last several weeks. So here we go. We had starting from 1.0750, the Canadian dollar fell all the way down to 1.045. And following a counter rally by the greenback, we retested this level to start this week, the 1.0350 level, and now we've moved below it. So that's an important development, and as long as oil keeps rising and risk appetite rises, then the Canadian dollar may be ready to test a lower support if we go back to October 14th around 1.02. So we'll see if the markets want to move towards this level or not. The Australian dollar pair also gained in today's session following a bit of consolidation in yesterday's session. So on Monday we had a pretty strong rally in favor of the Aussie after we moved above the 0.90 level, and now we're extending that move in today's session. Today's move breaks us above a resistance level that we had on December 11th, this line here, and our next resistance level will be this 0.9320 level. Now we have had a pretty strong rally since we bottomed out here at 0.8750, so we'll see if we need a bit of retracement or if the markets want to test this resistance before some profit taking occurs. The Aussie has been rallying against the yen as well in the later part of December and to start January. We had a break of a downward sloping resistance trend line just before Christmas time, and since then we've rallied about 450 pips. So following that break of the downward sloping resistance level, we had a horizontal resistance around 82, and we broke past that in last week's trading, and now we're testing the 85 area. So a combination of Aussie strength and yen weakness is giving us a strong move in this pair, especially in today's trading. If we zoom in, we see here. That should do it for today's fundamentals and market highlights. So let's see what fundamental releases we can expect for the upcoming session. Tonight, New Zealand and Australia both post their trade balance figures, while Australia also releases its retail sales. Overnight, both Germany and the Eurozone will release their retail sales. The Eurozone posts a measure of consumer confidence, and Germany releases data on factory orders. Tomorrow, the Bank of England will conclude its interest rate meeting, and we'll see if there is any word about its quantitative easing program. From the US, we get only one release, the weekly jobless claims figure, while Canada posts its IVPMI. And that will wrap up today's daily video recap. For more news, analysis, and for today's technical analysis video, please visit our site fxtimes.com. Thank you for watching, and happy trading.